3 million pages of evidence, thousands of unsealed flight logs, millions of data points, names, themes, and timelines connected. You are listening to the Epstein Files, the world's first AI-native investigation into the case that traditional journalism simply could not handle.
Welcome back to the Epstein Files. Last time, we walked through how Epstein infiltrated healthcare and genetics research to launder his reputation. Today, we're following his real estate empire, 6 properties across 4 countries, held through more than 25 shell companies, and how each one helped conceal both his wealth and his crimes. As always, every document and source we reference is available at epsteinfiles.fm. So in 2011, a deed gets recorded in Manhattan for 9 East 71st Street, one of the largest private homes in New York, valued at roughly $77 million. The transfer price is 0. The seller is a Virgin Islands entity tied to Les Wexner. The buyer is Maple Inc., another Virgin Islands entity controlled by Epstein, and Epstein signed both sides of the transaction.
That single document, the deed, is really the key. It's the starting point for this entire financial labyrinth.
It looks simple on its face, a property transfer.
Right. But when you really look at it, when you forensically examine the details, the signature block, the $0 amount, it reveals the entire operating system.
The pattern is established right there.
The pattern is there. The use of offshore entities to hold these major onshore assets, and it points directly to this incredibly complex and, frankly, inexplicable financial relationship he had with Les Wexner.
And before we get into the paper trail, we should probably establish the scale of the physical asset we're talking about here. This isn't just a townhouse.
No, not at all. 9 East 71st Street is a limestone fortress. It's a 50-foot wide, 7-story mansion just off 5th Avenue.
We're talking about one of the largest private homes in Manhattan.
Yeah.
The property records show it was built in the 1930s for the Strauss family.
Heirs to the Macy's fortune, yes. And for decades after that, it actually housed the Birch-Wathen School, so its scale is, institutional.
Over 21,000 square feet.
That's right. So when Les Wexner bought it in 1989, he paid $13.2 million for it.
Which, at the time, was a record. He never moved in. And this is where the timeline gets a little murky.
It does, because by the mid-1990s, Jeffrey Epstein is living in the house.
He's conducting business there. He's hosting people, scientists, politicians. To the outside world, it's Jeffrey Epstein's house.
But it wasn't, not legally. If you pulled the title on the property in, say, 2005, his name is nowhere on it.
So who owned it?
The property was held by something called the 9 East 71st Street Trust, an entity controlled entirely by Wexner. Epstein was, in effect, a tenant.
A tenant with no lease.
And total control. And that arrangement, that sort of informal occupation, it just persisted for almost 20 years. It wasn't until that 2011 deed that the title actually changes.
Okay, let's go back to that deed. The seller is the trust, controlled by Wexner. The buyer is Maple Inc.
And both are domiciled in the U.S. Virgin Islands.
And the price is listed is $0.
A $0 transfer. Now, in a normal arm's-length transaction, that's a deal between 2 independent parties. You just don't see that for a prime asset.
Unless it's a gift.
A gift, or maybe a transfer between 2 companies owned by the same person. But here, the entities were supposed to be distinct. One structure belonged to Wexner, the other belonged to Epstein.
And then there's the signature block.
That's the forensic anomaly. Jeffrey Epstein signs the deed as the president of Maple Inc., the buyer. He's accepting the property.
Okay.
But because he held a sweeping power of attorney for Wexner, he effectively authorized the sale from Wexner's trust as well. He was on both sides of the transaction.
He deeded a $77 million asset from his client to himself.
For free.
The power of attorney is central here, and we need to be clear what this means. This isn't the kind of limited authority you give someone to sign a document while you're on vacation.
No, absolutely not. The scope of the authority here was what lawyers call plenary. It's the nuclear option. It gave Epstein the power to do almost anything that Wexner himself could do financially.
The DOJ memos are very specific about this.
Yeah.
From the 90s through the early 2000s, Epstein could borrow money in Wexner's name.
Signed his personal tax returns.
Hire and fire staff, buy and sell real estate.
He wasn't just managing Wexner's money. She was operating as Wexner in a financial sense. He had the keys to the entire kingdom. And that level of integration, of trust, it makes what happened next even harder to understand.
This is the chronology problem. The documents and reporting all suggest the relationship between them completely falls apart around 2007, 2008.
Correct. The catalyst was reportedly Wexner's wife, Abigail, who discovered some serious financial irregularities.
And the phrasing Wexner's lawyers used later was that Epstein had misappropriated vast sums.
Which is a very polite corporate way of saying embezzlement, theft.
And there was a settlement. The DOJ memos show Epstein repaid $100 million to the Wexners in January 2008.
On top of that, financial records show he also transferred $46 million in stock and other assets to the YLK Charitable Fund. That's the Wexner Family Foundation.
So let's just walk through the timeline. To 2008, the fraud is discovered, the relationship is severed, Epstein pays back about $150 million. The breach is acknowledged.
The books are supposedly settled.
Which takes us back to 2011, 3 years after the theft, after the repayment.
Yeah.
The deed for the townhouse, the single most valuable asset in the portfolio, is transferred to Epstein for nothing.
It makes no sense. It defies all standard commercial logic. If an employee steals a massive amount of money from you, you fire them, you get your money back.
You don't turn around 3 years later and gift them a $77 million mansion.
So what does that suggest? From a forensic perspective, it suggests the 2008 repayment wasn't the final word. It implies that the townhouse transfer was part of some broader, maybe unwritten separation agreement.
Or it suggests leverage.
That Epstein had information, some other form of collateral that made the transfer of that property necessary. We don't have documents that prove blackmail, but the transaction itself lacks any other economic substance.
Whatever the reason, that 2011 transfer is the moment the Epstein operation fully privatizes its headquarters. The townhouse moves into Maple Link, and this really kicks off the strategy we see across all his assets.
The use of shell companies, the corporate veil.
Right, and you can see the full architecture of it in the estate inventory that was filed in the U.S. Virgin Islands after he died. That document is basically the balance sheet for the whole enterprise.
The total probate value listed was $636.1 million, but it's not a list of houses and planes under his name.
No, it's a list of corporate holdings.
It's a list of membership interests. He held $201.5 million in 15 different limited liability companies, or LLCs, and another $426.2 million in 10 separate corporations.
So if we map the assets to these entities, we have Maple Inc. holding the New York townhouse. What about the other big properties?
It follows a kind of botanical naming system. A company called Cypress Inc. held the Zorro Ranch in New Mexico. Poplar Inc. and Laurel Inc. were tied to other holdings.
And the jet, the Gulfstream.
That was held by an entity called Plan D, LLC. It was a 2007 model, insurable value of around $17 million.
So why do this? Why not just own the plane in his own name? What's the point of all this complexity?
It's about liability compartmentalization. It's about building firewalls. Let's say that jet is involved in an accident, or a pilot or a flight attendant brings a lawsuit for harassment.
They can't sue Jeffrey Epstein directly.
They sue Plan D, LLC. The lawsuit is trapped in that silo. And if Plan D, LLC, has no other assets besides the jet, the liability is limited to the value of that jet. It protects the townhouse. It protects the ranch. It protects his cash.
It separates the man from the risk.
Yeah.
And it also provides a layer of privacy.
A huge layer. If you're a journalist and you look up the tail number of that plane, you don't see Epstein's name. You see it belongs to some anonymous LLC in the Virgin Islands. You have to know how to dig through that specific jurisdiction's corporate registry to even begin to make the connection.
It's a system of intentional obfuscation. And we see it extending to his family, too. His brother, Mark Epstein.
Mark ran a real estate company called Asa Properties. Now, publicly, Mark has always insisted that he had no business overlap with Jeffrey. He's claimed their financial worlds were completely separate.
But the property documents tell a different story.
They show a clear physical and operational link. Asa Properties acquired multiple condo units at a building at 301 East 66th Street in Manhattan.
And that building housed many of the young women and associates in Jeffrey's orbit.
Exactly. And when you look at the public filings for Asa Properties, they list J. Epstein & Co. as a care of address for tax purposes.
Which directly contradicts the claim of no business overlap.
You generally don't list a company you have no relationship with as your official mailing address. It suggests that Asa was functioning as a sort of satellite operation, providing the overflow housing for the trafficking network, distinct from the main headquarters on 71st Street, but still operationally connected.
So we have this network of shell companies holding all the real estate. But these are cash-hungry assets. You have property taxes, maintenance, staff, pilots, jet fuel.
A shell company can hold a deed, but it can't pay a Con Ed bill without a bank account.
Which brings us to the financial pipeline. The real estate was the body, but the banking system was the blood. And the primary artery was J.P. Morgan Chase.
The scale of that relationship is just massive. The bank didn't just have one checking account for him.
No. According to the lawsuit filed by the U.S. Virgin Islands, J.P. Morgan held 134 separate accounts linked to Epstein and his network of entities.
134 accounts. And over a 16-year period, the bank processed $1.1 billion for him.
4,700 individual transactions.
And the court filings from that lawsuit included detailed expert reports that analyzed those transactions. And the patterns they found should have set off every single alarm in the compliance department.
The most glaring red flag was the cash.
The cash. The expert analysis highlights these consistent, very large cash withdrawals. We're talking about $40,000 to $80,000.
In cash.
Every single month for years. You have to visualize that. That is a brick of currency being handed over the counter.
In modern banking, for a client who's supposed to be this high-level financial strategist, there is zero legitimate business reason to need nearly $1 million a year in physical cash.
None. You can't invest cash. You can't pay major corporate vendors with cash. Cash in that volume is really for one thing: illicit, off-the-books payments.
Payments you don't want traced?
Payments to recruiters. Payments to victims. It creates a definitive break in the audit trail. Once that cash leaves the bank, it effectively vanishes from the ledger.
And the internal bank documents show that J.P. Morgan knew this was happening. Their own compliance officers were flagging it.
The risk management layer of the bank did its job. They filed what are called suspicious activity reports, or SARs. They flagged Epstein's accounts as high risk as early as 2006. They explicitly recommended ending the relationship with him.
But he remained a client for 7 more years, until 2013.
He did, because senior executives overruled the compliance team. The bank's own internal review after Epstein's death, a project codenamed Project Jeep, confirmed this. The executives looked at the revenue Epstein was generating for the bank.
And not just his fees, but the powerful clients he was bringing in.
Right. They made a business decision. They decided the profit outweighed the risk.
The USVI lawsuit put it very bluntly. It alleged the bank facilitated and concealed wire and cash transactions that were essential to the trafficking enterprise.
And that's the crucial link. The shell companies provided the secrecy. The real estate provided the secure locations. But the bank provided the liquidity. Without the ability to wire money or withdraw huge sums of cash, the entire operation just grinds to a halt.
The banking infrastructure was just as vital as the walls of the townhouse.
Absolutely.
So speaking of those walls, we need to shift from the paper trail to what was actually happening inside these properties. Because the FBI raids gave us a forensic look at the interiors. These weren't just homes, they were evidence lockers.
The raid on 9 East 71st Street happened on July 6th and 7th, 2019. Federal agents executed a search warrant and went through the mansion room by room. On the 5th floor, in a dressing room, they found a large safe.
And they had to saw it open.
Which tells you they didn't have the combination. The contents of that safe paint a very clear picture of a man who was prepared for flight and deeply invested in control and coercion.
Let's go through the inventory. $70,000 in loose cash.
That's your go-bag money. Immediate liquidity for movement.
48 loose diamonds.
That's portable, non-currency wealth. You can cross a border with a pocket full of diamonds much more easily than with gold bars or stacks of cash. It's a classic doomsday asset.
And a passport, but not his own.
A passport with his photograph, but a false name, issued by a foreign country. Some reports say Austria, some say Saudi Arabia, but the fact is he had a fraudulent travel document locked in his safe. It's an escape tool.
And then the digital media, the hard drives and the CDs.
This is the darkest part of the inventory. The handwritten labels on the CDs were explicit. Things like girl pics nude, misc nudes 1, and young name plus name.
This confirms that the abuse wasn't just happening, it was being documented.
It was being archived. The townhouse wasn't just a residence, it was a data center for the operation. And storing that kind of material suggests it had value, either as a trophy or
as leverage.
As leverage. It is the definition of compromise.
Now let's move out west. to the New Mexico property, Zorro Ranch.
Zorro Ranch was held by Cypress Inc. It's a 10,000-acre property outside Santa Fe. For perspective, that's about half the size of the island of Manhattan.
And it had a 26,000-square-foot mansion, a private runway, a huge hangar.
He bought it back in 1993 from the family of a former New Mexico governor, Bruce King, but the key characteristic of Zorro Ranch is just absolute isolation.
It's the opposite of the New York property. In New York, he's hiding in plain sight.
At Zorro Ranch, he's hidden by geography. The property is miles from the nearest public road. If a victim wanted to leave, they couldn't just walk out the front door and find a bus stop. The landscape itself is a prison wall.
Which makes the procedural failure surrounding this property so significant. Documents show that federal agents never searched the ranch around the time of his arrest in July 2019.
That's right. The FBI's initial focus was on New York and his home in Palm Beach. Zorro Ranch was left completely untouched in that critical initial window after his arrest.
But the New Mexico Attorney General's office eventually launched their own state-level investigation.
And their findings were unequivocal. They compiled over 1,000 pages of evidence. They analyzed flight logs showing more than 90 flights into that private airstrip. And the Attorney General's final conclusion was that the ranch facilitated the trafficking of children.
The physical layout supported that conclusion, didn't it?
It did. They found computer terminals set up in bedrooms, dedicated massage rooms. It was a facility, a purpose-built environment.
And then we have the island, Little St. James, and the USVI. The so-called temple building there has been the subject of so much speculation.
But the drone footage that emerged really strips away the mystery and gives us hard facts. The footage, captured by an operator known as Rusty Shackelford, shows this blue and white striped building that looked like a temple was just a facade.
The door was fake.
The main double doors were just painted onto the wall. It was a false entrance. And the drone's camera was able to peek through a window, and what it saw inside was a plastic-wrapped mattress on the floor and exposed wiring.
We in a temple. It was a stage set.
It was a functional, stripped-down space disguised to look like a landmark or a folly, and we know from architectural plans that were filed with the local government that he had plans to expand the infrastructure on that island.
There were blueprints for a separate ladies' residence.
And more isolated master suites. He was industrializing the location, he was increasing capacity, the island offered him total control, he owned the land, he owned the ferry service, he owned the helicopter, he controlled who came and who went.
It was the ultimate expression of this vertically integrated trafficking model.
Exactly.
But all of this, the 10,000-acre ranch, the private island, the jet, it requires a massive amount of ongoing capital. We've talked about the bank accounts, but we need to look at his tax structure. Because the way Epstein handled his taxes was, in itself, a major revenue stream.
This is the Southern Trust Company scheme. It's a critical piece of the financial puzzle.
Southern Trust Company was another USVI entity, 100% owned by Epstein.
Correct. It was set up specifically to take advantage of the USVI Economic Development Commission, or EDC, program. This is a local program designed to attract businesses to the islands to create jobs.
And if your company qualifies, you get a 90% exemption on corporate income tax, gross receipts tax, and excise tax.
A 90% break. It's basically a tax holiday. But to qualify, you have to be a real business doing real work.
So what did Southern Trust claim to be doing?
They applied as a data mining and financial consultancy. And on paper, they looked incredibly successful. Their filings reported $200 million in revenue over a 5-year period. They had retained earnings of $175 million.
But $200 million in revenue implies customers. Who was paying Southern Trust all this money?
That is the $300 million question. There is zero evidence of any external clients, no invoices to third-party companies. The audit trail strongly suggests that the revenue was just Epstein moving his own money from his other accounts into Southern Trust.
He was paying himself to manage his own money.
Essentially, yes. But by funneling that money into Southern Trust and calling it business revenue, that income became eligible for the 90% tax exemption.
So instead of paying the standard U.S. federal tax rate at the time, 35, 39%, he paid next to nothing.
The total estimated tax benefit, the money he saved by running this scheme, was around $300 million over the life of the company.
That's $300 million that should have gone to the U.S. Treasury.
And instead, it stayed in his accounts to fund the jets, the properties, the lawyers, and the settlements with victims.
And the USVI government eventually acknowledged that this was a sham operation.
They did. After his death, his estate reached a major settlement with the Virgin Islands. They paid $105 million plus half the proceeds from the sale of the islands. A huge portion of that was specifically to cover back taxes. It was a tacit admission that the benefits had been obtained fraudulently.
So we're getting close to the end of the timeline now. It's August 8th, 2019. 2 days before Epstein is found dead in his jail cell. He executes one final critical legal document.
The 1953 trust, named for the year he was born.
On that single day, he signs a document that pours $577 million of his assets into this newly created trust.
It was a last-ditch legal maneuver. By moving his assets out of his personal name and into a private trust, he removed them from the standard probate process.
And probate is public record. A will is a public document.
A USVI trust is private. The goal was secrecy. To hide the beneficiaries and to make it incredibly difficult for civil litigants, the victims, to freeze or seize those assets. He was pouring concrete over the money 2 days before he died.
And the executors he named for this trust were Darren Indyke, his lawyer for years, and Richard Kahn, his accountant.
The two men who built the entire corporate structure we've been talking about, they were the architects. And even after Epstein was gone, the movement of money didn't stop.
The USVI Attorney General later accused them of moving $13 million from the estate into something called the Butterfly Trust.
And other entities. The allegation was that Indyke and Kahn had listed themselves and their spouses as the beneficiaries of these new trusts. The accusation was that they were siphoning money out of the estate for their own benefit before the victims' compensation program could get fully up and running.
So the infrastructure was designed to protect the insiders first and foremost, even after the principal was gone.
Precisely. It was a machine built to prioritize the wealth of its operators above any legal or moral obligation.
Eventually, though, the machine was dismantled. The properties were all liquidated.
Yes, the sales data really marks the end of the physical empire. The 71st Street townhouse sold for $51 million, a significant discount, given its history. Most of those funds went to the victims' compensation program.
And the Palm Beach house.
That was sold for $18.5 million to a developer who immediately demolished it. The structure itself was erased.
The islands were sold.
To an investor named Stephen Deckoff for $60 million. The Paris apartment sold for about $10.4 million. Zorro Ranch was finally sold in 2023.
So the physical locations are gone or repurposed. The money has been distributed or clawed back. But when you look at the totality of it, the shell companies, the bank accounts, the tax scheme, the final trust, you see what it actually was.
It wasn't just a rich man with a lot of nice houses.
No, it was a vertically integrated criminal infrastructure.
That's exactly right. The shell companies existed to shield the liability. The real estate existed to provide the secure, private locations for the crimes.
The J.P. Morgan accounts provided the liquidity to maintain it all and to pay the network.
And the Southern Trust entity minimized the tax liability to keep capital reserves high. Every piece had a specific function.
And the complexity of it all was the point.
The complexity was the defense mechanism. It allowed a sophisticated sex trafficking operation to look, on paper, like a boutique financial firm with a high-end real estate portfolio. It took forensic auditing and federal raids to finally see the full picture.
We have the deeds, we have the bank transfers, the tax filings, we can see how it all operated.
But there are still gaps in the record. We don't have a full client list for Southern Trust if one ever existed. And most critically, we still don't have the contents of those hard drives from the safe. They remain with the FBI and have never been publicly released.
Next time, the legal reckoning.
You have just heard an analysis of the official record. Every claim, name, and date mentioned in this episode is backed by primary source documents. You can view the original files for yourself at epsteinfiles.fm. If you value this data-first approach to journalism, please leave a 5-star review wherever you're listening right now. It helps keep this investigation visible. We'll see you in the next file.